Hello, this is my final video about mind mapping on what we have learned during corporate finance class so far at IPMI International Business School Executive MBA program. Basically, what we have learned could be divided into two perspectives, from the perspective of company and the perspective of investors. We will discuss it separately. First, from the company's perspective, there are four main topics that we have learned so far. First topic is related to value creation. There are four principles that should be remembered for a company to create value. The first principle is core of value principle. Value is derived by return on capitals, growth, and cash flow. The second principle is conservation of value principle. Value cannot be created by playing a trick on cash flow. The third principle is expectation treadmill principles. Our company's performance must be kept up to match the investors' expectations on our share price. And the last principle is best owner principle. Basically, a company's value are determined by the owner's capability. Now, the second topic is related to capital structure. It's about finding the best mix of debt and equity usage to finance asset acquisition to be used for generating revenue, so the value of the company could be maximized. The point is, using debt at low level, it will provide the company with a tax shield and lower the weighted average cost of capital. But at a high level of debt, the weighted average cost of capital will increase because investors' risk perception on our company are also getting higher. The third topic that we've learned so far is related to capital budgeting. It's about evaluating the feasibility and planning the process for investment in long-term assets. The points are always careful in estimating expected future cash flow and evaluate the project properly using capital budgeting evaluation criteria such as net present value, profitability index, internal rate of return, instead of just using a payback period. In regards of carefully estimating expected future cash flows, it is particularly important when the company is conducting a leverage buyout transaction or even just simply acquiring something using a loan. There are a lot of examples when the debt could not be settled just because the company is unrealistic or imprudent in estimating the expected future cash flow that it eventually creates asset liability management risk to be unmanageable. The fourth topic we learned so far is related to dividend policy. For a private company, paying dividend to shareholders is a must. However, for a publicly listed company, there is a dilemma. Should a publicly listed company use its retained earnings for financing a profitable capital investments, or should it use the retained earnings for paying dividend to stockholders? The key here for a company is to find out how much from the company's earnings should be distributed to stockholders as dividend and how much from the company's earnings that should be retained for capital investments. Now, there are plenty of considerations for the company to be able to find out the answer from that question, such as using residual dividend theory, or clientele effects, or information effects, agency cost, and expectations theory. Now, after we've discussed the company's perspective, now we will talk about what we have learned about corporate finance from the investor's perspective. The first topic is related to time value of money. It's about the value of money today is different than the value of money in the future. Warren Buffett is famously known for saying compounding interest is the world's eighth wonder. For investors, the concept of time value of money taught us how significant a small amount of investment could be in the future if the investors is disciplined enough in regularly making investment. Combining time, consistency, and compounding surely is fruitful for the investors over the long run. Now, the second topic that we've learned about corporate finance from the investor's perspective is about securities investment. There are a lot of things that we could learn about securities investment. First, there are two kinds of investments. The first one is passive investing, and the second one is active investing. Passive investing means that we could just buy an index fund and spare ourselves from the required homework and nitty-gritty on valuations. While active investing means that we are actively choosing what investments should we make. Therefore, there are a lot of homework that we should do when we choose active investing. The second things that we could learn in securities investments is about the Warren Buffett tenets. It tells us about four aspects that we, as the investors, should pay attention to when evaluating a company if we have decided to use active investing instead of passive investing. The first point is regarding its business. We should assess whether the business is simple and understandable for us, the business have a consistent operating history, and whether the business have a favorable long-term prospects. Now, the second point is regarding its management. We should assess whether the management is rational or not, or whether the management is truthful and honest to shareholders, and whether the management is able to resist the institutional imperative. Anyway, the institutional imperative is meaning the tendency of the management to imitate the other company's behavior without thinking whether it was wise to do so or not. The third point that we have to assess is regarding its financial condition. We should assess whether we have already set our focus right. Focus on the return on equity, not just earnings per share. And next, we should assess whether we have already measured the owner earnings. Owner earnings itself is the Warren Buffett's method, meaning that the value of a company is simply the total of net cash flow expected to occur over the life of the business minus any reinvestment of the earnings. We also have to assess whether that company is having a high profit margin or not, and whether we already make sure that for every dollar retained, the company has created at least the same amount of dollar of market value. And the fourth point is regarding the market. We should assess whether we have determined the value of the business and whether there is an opportunity to purchase that business at a significant discount to the real value of the company. Now, we continue on to the third learning points about corporate finance from the investor's point of view, about what should we evaluate in terms of financial condition. In evaluating a company's financial condition, try to use a financial ratio analysis. There are profitability ratios, liquidity ratios, activity ratios, leverage ratios, and market ratios. Each of those ratios has a lot of breakdowns that we can find out on Google's. And the second point is, in understanding return on equity, it is better that we use DuPont breakdown to really understand the story behind those return on equity instead of just using a simple formula of net income divided by equity. Now, the third point about understanding the financial condition is focus on the story about the company's earnings, because every stock will be judged by the market based on its earnings. So don't just stop at tracking the numerical earnings on the spreadsheet, but look further on what makes the company valuable, and given all of the financial ratios result, why will that company be more valuable tomorrow than it is today? Now we can continue to the next point. It's regarding portfolio management. If we have more than one kind of securities, particularly stocks in this case, we have to use a proper portfolio management. Since basically investment is about managing risk versus return, we should calculate the required rate of return through capital asset pricing model, plus we should take into account the risk-related measurement like systematic versus unsystematic risk, correlation, and so on. The thing here is that we have to be careful with the high risk, high return jargon. Sometimes people use it so overrated that people tend to forget how high that risk could actually go. So investors should manage their risk. Now, the fifth point that we have learned is about market efficiency. The market is said to be efficient if the stock prices are reflecting all available information, so there is no abnormal return in the market. On the contrary, the market is said to be inefficient if the stock prices are not fully reflecting the available information, so we could make an abnormal return if we really do our homework on valuation. And now there are times that people arguing whether the market in Indonesia is efficient or not. But the point here is that market efficiency is not a matter of black or white. Upon the circumstances, there is always a fraction of market inefficiency. And if we really do our homework right, we could use it to bring an abnormal return for our investment. So that's it for my final video about my mapping on what we have learned during corporate finance course at IPMI International Business School Executive MBA program. Thank you.